Welcome back to the Real Estate Standard Podcast, episode 27, where commercial real estate and Bitcoin collide. I'm your host, Tim Kotzman. Today's July 8th, 2026. I'm joined by Kenny Alves and Chris Drizga. Each episode, we break down how serious operators, investors, and developers stay competitive and profitable in the 21st century by examining commercial real estate through the lens of Bitcoin. On today's episode, we'll be discussing commercial real estate volatility. But first, I'll hand it over to Kenny Alves for an update on Westmain storage stacking.
Hey, Tim, thanks. As of today, July 8th, we hold 15.56 Bitcoin, 1.56 billion Satoshis. So far in 2026, we have stacked over 13 Bitcoin, 1.3 billion sats. And year to date, we're over 600% Bitcoin yield. What does that mean? We've 6 times our Bitcoin stack since January. And our Bitcoin per square foot metric is now at 22,422. And a few weeks ago or a month ago now, we officially achieved Bitcoin square foot parity. And what is that? That is a metric that we coined. There's approximately 97 billion square feet of US commercial real estate. And if you divide all the Bitcoin that will ever be, 21 million, just under it, you would come up with 21,649 sats per square foot. We have crossed that line by over 700 sats now. We have also received our latest digital rent payment from Strategy. We received our last monthly dividend from Stretch. Going forward, they'll be every couple weeks. They'll be bi-monthly. We've received just under $10,000. That's about the equivalent of 33, 34, 35 10 by 10 climate controlled storage units. So we're adding income stream. It's roughly about 15% increase in our NOI. And it's going to be about $120,000 a year now that the dividend was increased to 12%, 1% a month, paid out, 0.5% every couple of weeks here. We got the new chart up on the dashboard, the Bitcoin acquisitions chart. And you can actually see a couple dotted lines as well. We got those fired up and working. It's showing the average cost basis over time. And so you can see both the average cost basis before the tax loss harvest and after. Chris, what do you think about all this?
It's just really exciting to see the strategy really start to come full circle here. I feel like we've been, slowly integrating all these different approaches and just strategies, and one by one. And now, looking back over the last almost 9 months, and just seeing how far we've come is incredibly encouraging. You mentioned the Satoshis per square foot metric every single week, and I think that's going to be a really big story moving forward here, because the sats parity metric that we keep massaging here, so to speak, is I kind of think of it as it's underappreciated, right? If you look at some of the larger public storage facilities, right? The operators, the public storages, the Extra Space, the CubeSmarts of the world, for them to meet or exceed Westmain's Satoshis per square foot, they're looking at massive Bitcoin positions. I think public storage is has the most square footage. I think it's 185 million square feet total in the portfolio. For them to have equivalent or greater sats per square foot, they'd have to have 40,147 Bitcoin. That's just one operator in that space, mind you. So If Public Storage were to somehow acquire that number of Bitcoin, that puts them in the top 5, maybe the top 10 spots of Bitcoin holders across the globe. That's assuming everything else remains constant, and as we know, that's not how the market works. That's not how the network or game theory ultimately plays out. So I think Westmain's Satoshis per square foot is going to be a major metric moving forward, and you guys are punching above your weight class in a really, really big way here. So I'm excited to see that one unfold.
I don't know if you can see on the screen now. I just pulled it up. We have this kind of live tracker here. I don't know if I've showed it to you, Chris, maybe a few times, but you can actually see Extra Space has 308 million square feet, and this is pulled from their filings. And the cost to match our Bitcoin density would be $4.3 billion. They would need 69,304 Bitcoin. That would put them as the second largest Bitcoin company. Just pause there. Just
let that one soak in, right?
Yeah, maybe I'll say it again, but we can go through each of these. Look, CubeSmart, another storage giant, 10,292 Bitcoin to match our Bitcoin density. And we also calculate how many months of dividends they would have to suspend to catch up. Now, they have much larger portfolios. You can see our square footage is 69,420 square foot, single facility. But the REITs normally have a huge advantage, right? They're able to consolidate their marketing, their website, their management. They can cut costs by having a lot of facilities. So it normally goes the other way around. Normally, single facilities are going to. We have another chart that I can pull up, and we can see that we're kind of competitive. But if you look at size versus income per facility right here, we're going to be bringing in more revenue with less square footage after this refi once we deploy to Bitcoin and digital credit. And then we can also see right here, we can just kind of break it down a little bit more, like how those numbers are calculated. And then another cool thing is if we were to also value the Bitcoin that we currently have and assume that it's going to appreciate at 30% in this scenario, you can see that we're going to have another revenue stream that we don't really talk about much, right? We don't really talk about that mainly because it's a bear market and we're down currently. But over the long term, our thesis is that Bitcoin will appreciate, around 30% year over year. And that's going to be an additional revenue stream that we haven't really talked about. And we also calculate if these REITs were to adopt our strategy and convert their cash that's sitting on their balance sheet. Right now, Public Storage has roughly $1.1 billion in cash reserves. They could buy 17,000 Bitcoin, assuming it's for sale at all. They can buy it all at this price. Sure, the price would start running away after, buying in here. Maybe not, right? Strategy has buys of this size fairly regularly. But this is the amount of Bitcoin that they could buy like today, assuming they had like the mandates and the board approval and shareholder approval. This is how much Bitcoin they could accumulate with their cash reserves. So yeah, this is kind of, I'm glad you brought that up and we can go over this.
I think there's, that last point you said, Kenny, as far as the board approval and having the procedures in place, all of that. I mean, that can't be understated, because I think that's a huge barrier to a lot of these players, moving forward and adopting this kind of a strategy. So, there's that to consider. The other thing, which I think will be interesting to see play out, is, if and when these operators go this direction, are they going to buy spot Bitcoin and have a custody strategy, or are they going to go and buy IBIT? Right. I mean, I think it'll be interesting to see how that plays out. I mean, if I was a betting man, I'd probably say they're going to take the path of least resistance and go the ETF route, just so they could say, hey, we have some exposure. And, they also have the REIT rules. I think they have to distribute 90 or 92% of their free cash flow to their investors. So there are limitations there on, how big that position could ultimately be. But all that said, I think it's going to be interesting to see it play out. And, as we've talked about before, I think the market has not fully digested or fully appreciate the fact that this is not only an absolutely scarce asset, but it's an absolutely scarce asset that is a bearer instrument, right? That can be held in self-custody. So as this, as we get further into this decade and beyond, and you'll have all the major, macro forces at play here, in addition to the mining rewards getting cut in half again in 28 and again in 32, trending to zero there, there's going to be at least one or two, oh shit moments where this thing is, you're not going to be able to keep the lid on it. And I think there's going to be, and, to that point, it's going to go both directions. Don't get me wrong. It's not a one-way street, but I bring all that up because in that scenario, these operators are going to find out the benefits of self-custody, right? They're going to want to know that they have their Bitcoin in cold storage under their control, offline essentially, rather than, some paper shares in an ETF.
Yeah, I totally agree. We're in what you could call the final countdown. We have less than 1 million Bitcoin to be mined, and that's going to take over 100 years. It's going to take 113 years to mine that last 1 million Bitcoin. And, we're halfway through this epoch. So the halving is coming. What does that mean? Well, it means that the block reward is cut in half. Every approximately 10 minutes, a block is solved. And the current reward is 3 1/8 Bitcoin. So 3.125. And, in less than 24 months, we're going to see that go to, what does it come down to? 1 and change, right? So you're not going to do the live math. I always forget not to do that.
It's going to be a wild ride. So buckle up and make sure you have your custody and your security protocols in place now. And, just to add on to that, we've talked about it the last few weeks here as well, is make sure you have your administrative matters in place. Make sure you're keeping good records. You're tracking your lots, your purchases, and you have, guardrails in place essentially to help steer decision making in both good times and bad.
Yeah, and I want to circle back to what you said about real Bitcoin versus paper Bitcoin. And I think that there's, several things to consider. One, it's good to see people get their foot in the door, no matter how they do it, whether it's through the ETF or through IBIT or through strategy preferreds or other issuers. But you can't understate the importance and the difference of, spot Bitcoin versus some of these paper instruments. And I think like a way for real estate folks to wrap their head around it would be like the difference of, how some properties are held, right? Some are like a condo, or some are like a timeshare, right? Like everybody in real estate knows that you don't really want to own a timeshare, right? Like you have the least amount of rights. And I think that's a way to think of it with some of these paper products. Like you're getting the least amount of rights to the property, right? Because again, Bitcoin is property, and they're stripping away your rights. So like the most important piece of Bitcoin, in my opinion, is the decentralization component, and the fact that it's permissionless and anybody can send it if you have the actual Bitcoin. I don't need a third party's consent or approval to send from my node to Chris's node. Now, if that's the most important component, but when you buy something like IBIT, you can't, you've given that up. So on one hand, you're saying this is the most important feature of Bitcoin, that it's 24/7, it never sleeps, it's peer-to-peer, right? Everyone likes to champion that. But then when you talk about IBIT, well, you can't transfer it peer-to-peer. You can't sell it on a Sunday, right? So you give up a lot of the things that make Bitcoin what it is when you go. But it's not to say it's like either or. You know, there's reasons and like scenarios in which you can have a combination of these things, or, you know, you evolve. You start off with less rights, and then eventually you educate yourself and your business, and you learn more, and you take more control of the asset.
Yeah, I like what you said there as far as the timeshare example. I was thinking similarly the last couple weeks as well. It's kind of like the anecdote I used was a DST, a Delaware Statutory Trust, which has doesn't have the best reputation in the commercial real estate investment world either. You're giving up a lot of control. Those vehicles have you never know what deals are in the thing, right? What do they pay for? What does the tenant what does the rent roll look like? Et cetera, et cetera. So people are taking the path of least resistance. You're basically trading some of the headache and the management for returns and control. They're looking for mailbox money. And to your point, Kenny, I don't think there's anything wrong with that necessarily, right? Everybody's got different situations and different goals. I don't think the ETF, the Bitcoin ETFs are a good alternative for your Bitcoin position, but digital credit and the cash flow streams, that I think has a very important role to play in real estate. And I think that's why we have found, not only Westmain found good product market fit with these things, but the broader retail market as well. Especially with real estate being such a capital intensive asset or capital intensive business, maintaining the liquidity is crucial, right? And I think this is going to be a good segue into a couple of our talking points today. Maintaining that liquidity is crucial, but also making some of those interim reserves work harder is a game changer for a real estate operator. And the biggest objection from the real estate community, since we started doing this whole thing, as to why they are unwilling to integrate Bitcoin into just a treasury, reserve asset or on their balance sheet, is because of the volatility, right? And now you start to, okay, here's what we're working with. There are new tools, there are new products available that are built around sound money, digital capital, pristine collateral, however you want to coin it. There's real use case there.
Yes. Speaking of volatility and new features, I don't know if you guys saw it, but Strike announced that they now have a loan where you cannot be liquidated. You cannot be margin called. You can borrow against your Bitcoin, and you don't have to worry if the volatility is going to come and give you a margin call. Now, it's important to note, like, these are still kind of early days for Bitcoin and Bitcoin financialization products and services. And it's important to note real estate has some of the best financing options. And that's like why we see this opportunity to bridge real estate with Bitcoin. What we're seeing with Bitcoin right now is mimicking a lot of real estate things as far as the preferred equities, right? Real estate was one of the best use cases for preferred equities. And now with some of these kind of loan options, we're seeing some companies issue stuff that they call like a I think one of them has called it block, which resembles a HELOC, right? Where you can draw down against the Bitcoin and um, manage a level and pay it off as you see fit. And I think we're going to see all the types of real estate products that we have today for commercial real estate make its way to Bitcoin, because it's, again, property. I can't say it enough that we're dealing with two different types of property. It's almost like you have your mixed use zoned property, you have your general business zoned property, you have your retail zoned property, and now you have your digital property, Bitcoin. And it's just an extension of what we've already built for physical real estate that's going to have to cross the chasm here and be built for the Bitcoin industry.
Yeah, well said. And I said it a couple of weeks ago. I'll say it again. We're witnessing the financialization of Bitcoin. There's going to be winners and losers along the way. There's going to be good ideas and bad ideas along the way. Ultimately, that leads to hyper Bitcoinization. The only question is, how tumultuous is it from here to there, and how do you navigate it yourself? How are you allocating your portfolio, and how much risk are you taking on personally? So I think there will be multiple real estate operators that integrate different Bitcoin strategies. There will be multiple preferred equity issuers. Some will be better than others. Same thing with the insurance space, and you'll see ideas get spun up in every industry in the economy over the next 3 to 5 years, and there's going to be a lot of creative destruction, but it's going to be really exciting to see what works, what doesn't, how the market responds, so on and so forth. And I think that's kind of a good segue, Kenny, into one of the talking points for today, and that was the concept of this, the fifth return driver for commercial real estate operators. And Westmain has been demonstrating this in real time over the last 27 weeks, basically. Real estate operators are very familiar with the existing return drivers. Those are net operating income growth, your cap rates, leverage, and then capital improvements, right? Those four levers have shaped real estate returns for at least the last 5 decades, probably longer. What we're talking about here is, or what we're talking about with those first 4 return drivers, is it's all dependent on the property. It's dependent on perfect market conditions and essentially the stars aligning. What we're talking about with this fifth return driver, you are able to navigate difficult market conditions irrespective of the strength of the balance sheet. And that's the balance sheet appreciation. The active balance sheet management is the fifth return driver, and that's where Bitcoin comes into play. And like I said, Westmain has been demonstrating this the last 27 weeks with this type of strategy. The last couple of weeks being the most recent with the tax loss harvesting. But you're able to engineer your balance sheet in a way that helps you create optionality, but also navigate uncertain or difficult market conditions. You can also use it to bridge vacancies. There's a whole list of different scenarios that can either be applied to or benefited from this active management of the balance sheet via Bitcoin holdings.
Yeah, you kind of open another can of worms here. I was gonna suggest we do maybe we can do a follow-up episode on it, and we'll just kind of touch on it right now. But there's been several Bitcoin companies trying to put together what they call like a Bitcoin Berkshire Hathaway. And, I think it's a great idea, right? And so I started looking into it. I think everybody kind of knows the origin story a little bit. But Warren Buffett and Charlie Munger saw this textile company, and it was Berkshire Hathaway, and they decided that they were, going to give it a shot. was producing some cash flow, and they, took a bet on it. And I did some digging, and I found out like the origin of that textile company actually started in Rhode Island, in Central Falls, Rhode Island. And it was a textile company. It was like 1800s. We'll have to do like a full episode on it, right? And basically it went through a few different mergers, the Central Falls Textile Company. And I think the first one was with Berkshire Cotton Manufacturing in Massachusetts, in New Bedford, I believe. So it's like so funny because that's our stomping ground, right? We're a Rhode Island self-storage company, and we're essentially doing the Berkshire Hathaway playbook, but on a Bitcoin standard. And what they did was they took those cash flows from these manufacturing companies, this textile manufacturing company that grew over mergers and acquisitions, and they reinvested that money and started insurance companies or bought insurance companies. I got to touch up on the research there, but the whole point being they were reinvesting the cash flow into different assets, right? And they what they thought were undervalued assets. So they were like value add investors. And I think that's kind of what we're doing in our own unique way as Bitcoiners. Bitcoiners have brought us back to those, like, that line of thinking. And yeah, it's just kind of, it's funny how that happened to be a Rhode Island company from the start, Central Falls.
I think now that you say that, I think when we had Dan Hershey on earlier this year, he had mentioned something to that effect, if I'm not mistaken. But we'll have to go back and loop that into the episode when we do it.
Definitely.
But yeah, no, I've heard a lot of different conversations about the Bitcoin Berkshire Hathaway venture, if you will. That sounds great. I'm excited for it. I think it's a nice phrase to drop, or a nice buzzword to drop to get people's attention and interest. But I think I think most people are just using it as that, right? It's not something that can be spun up overnight. It's not something that can be put together through a series of M&A, in a quarter or two. I mean, maybe it can, but it's not going to be, anti-fragile and have the resilience that you ultimately want in a, Berkshire Hathaway-like vehicle or entity. So I think there's going to be the Berkshire Hathaway of Bitcoin in the future. I just don't think it's going to be, in the near future. I think it's going to take, multiple years, even multiple cycles, to let all of these strategies play out, let the monetization phase play out, see what works, what doesn't. And, there will be one that emerges over the next, decade or so that is that behemoth. And by that time, they've probably acquired different operating businesses that touch a variety of different industries. So they have not only the underlying operating business to point to, but they have the cash flow that comes from that, the correlation or lack thereof from broader market conditions or asset classes. So yeah, I'm excited. I think that will happen. I just don't think it's going to happen nearly as quickly as some of the people have been parroting that phrase. You know what I mean?
What I think you're saying is that, the people that want to do this, they're not willing to get their hands dirty and go in the trenches and build, and like actually build and develop the cash flowing business from the ground up, and spend the time, slowly but surely. And then it's like gradually but suddenly, right? And I think a lot of people,
They're using. Sorry.
yeah, I was just gonna say, I think like they want to use like a shortcut, and the shortcut is like raise the capital, roll up the businesses, and then we're generating all this cash flow. But you did it, and you have like a big cost of debt to do it, because you didn't, like, start from the bottom. essentially.
Yeah, the way I think of it is they're using fiat tactics or fiat shortcuts on top of Bitcoin or with Bitcoin. And you and I both know, we've been around long enough to know that those don't mix for very long. It's like oil and water. So um, yeah, buyer beware, I suppose. But anyway, just to kind of put a bow on this whole fifth return driver concept, and we're still kind of mulling it over, obviously. But like I said, I think Westmain is a perfect test case. We've been demonstrating this in real time over the last 27 plus weeks. But I think the bigger takeaway here is, as a real estate owner, when you hold Bitcoin, whether it's at the entity level, the portfolio fund, or even the family office level, part of that ownership value is no longer tied to the building or to the property itself, right? It's not dependent on rental growth and leasing activity, the interest rate environment, what have you, right? The typical components of a real estate business. A portion of the owner's value is now tied to this completely separate, liquid, global, decentralized asset that is appreciating independently of any real estate market. That cannot be overlooked or understated. That it changes the entire equation as to how you not only allocate your capital, but how you manage your operations, whether it's a single property or a broader portfolio, like some of the competitors we were talking about at the top of the hour here. So that's what this fifth return driver is, and again, it's going to change the entire game.
Yeah, I think like we've seen this in the traditional markets. Tesla is a great example. They had so many revenue streams that everyone was looking at them as a car manufacturer for the last decade, and I think we're finally starting to see, people realize that, hey, they have all these different revenue streams, and once they start, merging, there's talk about merging with SpaceX, and I think Elon's been very open about his idea to kind of have it all under one roof eventually, the everything app kind of thing, so um, you start seeing all these different revenue streams, right? They have solar, a solar component when they bought Solar City. They don't really talk about that much. They have the full self-driving. They have, the cars. They have the Tesla semis. They have
the data collection.
Yeah.
I mean, that's going to be, that's probably the biggest one.
Well, yeah, that they have their like their own. The other thing is that Tesla has been an AI company longer than people realize. When the founder of Anthropic, one of them, worked at Tesla and worked on the full self-driving, and like set the things up to train all the data. So I think like some of these revenue streams, they may not be significant at first, and they might go like unnoticed, but over time they become the lead form of revenue for the company in some cases, right? Like look at Starlink with SpaceX. Like Starlink is one of their biggest revenue drivers now, and now they're going to shoot data centers into space. I just saw something on X where they're going to be able to get an insane amount of these things they're going to obviously build a bigger rocket, but they're going to be able to shoot so many data centers per load, where like that's going to become their main revenue stream, something that didn't exist just 12 months ago. And
yeah,
so for us in our world and real estate, those new revenue streams are Bitcoin and digital credit, and anything that you can put on the balance sheet and adjust and use to add revenue and to help the net operations. So I think that's like the other thing is like a lot of people kind of write it off and say, well, Chris, this is like you said, it's like completely different revenue stream. It's not tied to operations. It doesn't deserve to be NOI. And that's where I kind of get a little upset because it has a huge impact on your operations. If you're able to kind of terraform your ordinary rental income from like, you know, a less desirable tax classification to return of capital, rock dividend income, something that's tax deferred, you're like doing like you're increasing your NOI by so much. But I think the big problem is a lot of the, you know, the people that you would that don't care about it don't really care about the businesses after tax revenue or cash flow, right? Like we see like all these metrics, EBITDA, and operators could care less about EBITDA, right? Because what is
Yeah.
what is going to end up in your pocket? That's what we care about, and all that stuff gets obscured away. And with digital credit and Bitcoin, it basically helps you keep more of the money you earned. You pay less taxes. It's like a like you. I know you've said it multiple times now. It's a huge tax shield. And I think real estate guys, they're always looking to minimize their taxes, like you also say. And that's like the main reason real estate people should look into this. Do you like paying taxes? Because you're going to either pay Uncle Sam or you can add some digital credit to your balance sheet. And once you realize that, that you got this dead capital trapped on trapped equity, right? I see people posting and bragging like, oh, you know, who cares if I got, you know, all this trapped equity? Well, you're not beating inflation. You're just getting rich slowly, or poor slowly rather.
Yeah, pour more slowly. No, yeah, I think you're exactly right. And the nuance there is missed on a lot of the players in the space. I liked your Tesla example. Another one that comes to mind beyond Tesla and Berkshire is, you know, is Amazon, right? I mean, we all know their story, and now, you know, in 2026, how many different revenue streams and business lines they have, which, you know, bringing it back to real estate, it gets me that much more excited and bullish about Westmain and just the future real estate operator, because how many times have we talked about it on this show, Kenny? It's the most successful real estate operators are going to be experts in real estate, Bitcoin, energy, and AI, right? Like you're going to have to understand and execute all four of those pillars in some capacity on your properties in order to stay competitive, attract capital, et cetera, et cetera. And again, bringing it, you know, selfishly bringing it back to what we're doing here, we have a running head start.
Yeah, I kind of forgot to check in. I'm glad we did that in the beginning of the episode because, you know, we're just one small facility and it doesn't look like much, 22,000 sats per square foot. But when you go look at the size of these commercial real estate portfolios, how are they going to accumulate that much Bitcoin per square foot, right? Like we're almost 100 million square feet of commercial real estate. So, or 100 billion, sorry, 100 billion square feet of commercial real estate. So, yeah, I just like, what does that do to the price? Does it push them to these paper products? Does it maybe do they like try to like I just don't know exactly what the path is. It's gonna be like a bumpy road for sure. But yeah, these numbers they're compounding and like we're not stopping. So like if they wait another year, like how much Bitcoin are we gonna accumulate in another year? Like at a certain point it's going to be unobtainable. I think that's what you were kind of hinting at before. Like at a certain point it's like the only way they catch up to us is if we acquire more real estate, which inevitably we probably will do, right? To maintain a ratio, right? If you're at, you know, multiple Bitcoin per square foot, maybe you should think about, you know, borrowing against some of that Bitcoin to accumulate some real estate, and your Bitcoin per square foot would come down. as you acquired the real estate. You don't have to sell the Bitcoin, right? You borrow against the Bitcoin, you buy the real estate. Now you just have less over collateralization. So I think once you build up these cross collateralized assets and you have such a buffer, that's when you can play with those ratios and grow. Maybe you start to grow the solar portfolio. You add some megawatts of solar. And that's kind of, we were talking offline about, the different buckets that we allocate to, and having those levers and having those predefined. I think that's another thing that kind of sets us apart. I know we're a small Bitcoin treasury company, but I think we have a plan in place to monetize the Bitcoin that we're trying to acquire. Like, we have a different problem.
Yes.
We have, like, how do we get 10,000 Bitcoin on our balance sheet before we can start doing the cool engineering that we want to do, right? And we see a lot of these Bitcoin treasury companies, they got 2,000, 10,000 Bitcoin on their balance sheet, and they're struggling to generate revenue. If I were them, I would borrow against the Bitcoin, not all of it, but I would borrow against it to buy real estate, to increase the cash flow and grow the real estate, and be very selective, right? Like, you don't have to like rush to do it, and you're not selling your Bitcoin. You're leveraging your Bitcoin in a responsible, intelligent way.
Yeah, well said. I mean, I think that you're hitting on the concept of the three buckets that we've talked about time after time here. Is, you have Bitcoin, you have digital credit, and you have real estate. And in our opinion, the highest and best use of capital today is to acquire as much Bitcoin as you possibly can. The second best use of it is to establish a digital credit position to utilize the income stream, but also maintain the liquidity and the optionality there. The real estate bucket doesn't get any love right now because there's not enough distress in the real estate markets to justify that time and energy. If you can, leverage your relationships and different skill sets to find distressed deals or high quality opportunities, then fantastic, right? But those are not the ones that are posted on CoStar and LoopNet. That's just not how it works. So it goes back to your point, Kenny. Having Bitcoin on the balance sheet and utilizing some of these strategies gives you that optionality, and part of that optionality is the ability to do nothing, right? Like, do nothing. Sometimes that's the best thing a business owner can do in an uncertain or even a volatile period. And I think, and I don't know if we'd be able to find somebody that wouldn't disagree with us or that would disagree with us that we're in volatile times right now. So I just don't think the dislocation has occurred in the real estate markets to the degree we know and expect it to be, which is fine. Let the music play on, but in the meantime, build up your other two war chests so that you can move quickly when those opportunities arise. And there's ultimately blood in the streets. That's how you're going to build out the real estate arm of the Berkshire Hathaway that you're describing.
Yeah, I think what you're saying is the distressed assets right now are Bitcoin and digital credit. They're undervalued, right? Those are the distressed properties that you should be looking at. Now, I think if we had 10,000 Bitcoin right now, we could still go acquire real estate. The reason is because we're putting the Bitcoin to work. We're using it as a dual collateral system. And so I think that kind of change. I think it's like, there's like, for us specifically right now, like if we had, if we raised a large amount of cash, we would deploy it right into Bitcoin and digital credit, because that's the distressed asset. And we don't have enough Bitcoin yet to go out and acquire more real estate. Like our balance is like about $1 million of Bitcoin, right? Like we need tens of millions of dollars before we're going to think about acquiring another property, right? Mm-hmm. And so it's kind of, we're in the trenches. We got to kind of build slowly, but we have a unique problem. And I think like we have the solution for a lot of these treasury companies that have amassed this amount of Bitcoin, because now they have it, and they're like, people don't want to give them any more Bitcoin, essentially, because they don't know what to. It's like, well, show us what you're going to do with the Bitcoin. You already got 10,000 Bitcoin, put it to work. And we have a different problem. We have to get people to trust us and want to invest with us to be able to acquire that level of Bitcoin, right? To get us to 10,000 Bitcoin, then we can start thinking about, well, hey, let's put this to work and use a portion of it. Let's use 1,000 Bitcoin, borrow against it, try out maybe some of these new Bitcoin lending tools from Strike and other, companies in the industry, and let's go acquire some facilities so we can start to, test this theory out, test this thesis out, and do it in a very intelligent, responsible way. But right now, the distressed assets are Bitcoin and digital credit, and
Yeah.
but it could be something for other treasury companies to look into.
Yeah, no, I think that's a great segue into the other topic for today, and that's the commercial real estate volatility. I mentioned it at the top of the hour here that the biggest objection I get from different real estate folks as to why they are not interested or unwilling to consider Bitcoin as this new tool, and it comes down to the volatility every single time. And now most recently, everybody gets to point to the 50, 60% declines we're experiencing from the all-time highs. And and fair enough, okay. But to your point, Kenny, now's the time to be accumulating, not selling or running scared, right? I mean, this is where the legends are made. This is where the big bucks are made. That everybody likes to listen to at the keynotes when you're in the bull market. But that all said, I started thinking about volatility a lot, and I was thinking about how volatility is looked upon and materializes in real estate. And the more I thought about it, the more I started to say, like, hey, there's a double standard here, and the volatility in real estate is just as significant as it is in Bitcoin. It just it materializes in different ways. It shows up in a different way, and most notably over at a much slower timeline. And I think that's why the market disagrees with me, essentially, right? I mean, Bitcoin price is updated every couple of seconds. It's on your phone, it's on social media, it's everywhere, and it's telling you what it's worth. Commercial real estate doesn't work that way, right? There's no live ticker for your 2-tenant building or your neighborhood retail center, right? The appraisals lag significantly. The sales comps are they age very quickly. The owners can avoid marking their assets to market until there's some kind of refinance or a sale or a lease expiration, right? So that delay creates the appearance of stability, but delayed price discovery is not the same thing as low volatility, right? It just means that the volatility is hidden, right? It's buried inside of the asset, right? Whether that's the income stream or the tenant rent roll, the loan structure, what have you. And in real estate, I think the biggest or most obvious way, I should say, that operators hedge risk or hedge their volatility is through the income stream, and even more importantly, through the tenants, right? So the quality of the tenants impact the overall value of the asset, right? And it's a large function of the NOI. So you can see people act on this through assigning premiums to higher quality businesses or tenants. You can also see them mitigate this risk by opting for a multi-tenant building rather than a single tenant building or a 2-tenant building, right? If you have a 2-tenant building and one of your tenants moves out, your value, your NOI just took a 50% decline, right? I mean, that a 50% decline in your real estate income is not fun. That hurts. But on the other hand, if you have a 10-tenant building, a 10-tenant light industrial facility, you lose one tenant, you're still at 90% occupied, right? So again, it shows the volatility is there. It just shows up differently.
Yeah, I think, the volatility is greatly abstracted, like you mentioned. And I think, real estate benefits because liquidity doesn't come from the sale of real estate. Like I've said this a few times that in commercial real estate, there's an expression, you can't afford to sell, especially when you're a real estate developer, right? Like for us at Westmain Storage, if we were to sell, we would have a huge depreciation recapture, and we would also have a huge taxable gain that would equate to more than had we just refied and pulled out the money tax free. So how do you get liquid in real estate? You pull the money out, you refinance the property, because when you refinance the property, the proceeds from the refi are going to be more than the net sale after you pay taxes. So anyone in real estate that's looking to get liquid is just going to refi the property. So comparing that to like a sale, like, who sells real estate is the children of somebody that owned real estate for a long period of time. Why? They get the stepped up tax basis, and then they don't have to pay the tax. And you know what? It's always a mistake to sell it, because had they held on to it for another few years, they would have gotten that amount of money and still had the property. Like that's why real estate is like, gold was the first forever hold asset. Real estate arguably could have been the first forever hold asset, because it's like a golden goose. Once you refinance it, you get the tax out cash free. Our all-in cost for Westmain Storage are $3 million. We could probably sell it today for 18 million, like not even trying to maximize the premium, right? Just list it, sell it in 30, 60 days. Our the taxable hit on that, like we're going to be taxed on $15 million in gain. What's 37% of that? That's why you can't sell your real estate. That's why people like Bitcoiners are always trying to dunk on real estate guys. And it's stupid to do that. Why? Because you want the real estate guys to buy Bitcoin and digital credit, and going around saying misinformation isn't going to get them to show up to buy digital credit. They're going to despise digital credit. They're going to be like, these guys have no idea how real estate works. Why would I buy digital credit? So sorry for that.
I think what you're getting at is and this is kind of an evolving opinion of mine, is, using the real estate as the generator, the cash generator to accumulate positions in these other vehicles, right? And I'm not saying that all real estate is created equal, and all real estate is a forever hold. It's not. But I think you need to. I would revisit that assumption. Maybe I'd be a little bit more forgiving on some of my prior comments as far as what real estate has value into the future and what doesn't, right? Maybe there's some buildings that you should hold on to because you have these mechanisms that you're describing here, Kenny, that serve as not only tax advantage, but they serve as that generation, that engine that can help fuel these other two capital buckets. Right. But at the, going back to the volatility topic, I mean, a lot of these properties, again, 62% of the existing inventory in the country, 60 plus billion square feet of commercial property was built before 1990. Right. A lot of that is functionally and economically obsolete. Right. So in that scenario, an owner has to have a very frank and objective assessment of the asset. Is this worth holding on to or not? especially when you have your expenses increasing, double digits annually, right? You don't have the appreciation in your in your rents to keep pace there. So that that's where this conversation becomes incredibly nuanced, because it's so property specific, it's so location specific.
Yeah. Location. That will never really change for the most part, right? Because if you're in a flyover state, right, you're not going to be able to necessarily, um, maintain those premiums, right? Because the land is a little bit more, less scarce there. But yeah, these are valid points, and I think there's a huge difference if you got cash on the sidelines and you're looking to deploy the cash. That's what we keep coming back to. If you have the cash, the best move right now is to buy the digital credit, buy the Bitcoin, right? But if you already own real estate and you can't really sell it because you got this big tax hit, like that's kind of where we're trying to, most of what we talk about applies to, right? Because it's really like the operators that already have the property, that have already extracted their original down payment or contribution into the business. They've already extracted that and probably have gotten multiple returns on that initial capital. And they have a big tax hit if they're going to sell. So that's kind of like the playbook that we're kind of creating. It's like for the real estate operators of today. The real estate operators of tomorrow, I think, are going to be the ones that are looking to leverage their Bitcoin, right? Because you can grow a real estate portfolio out of nothing without sacrificing that Bitcoin. So I think we agree on that. And I just think some of these comparisons, when you compare real estate to Bitcoin, they don't necessarily, it's apples to oranges. It's quite literally apples to oranges. You have, Bitcoin is a non-productive asset in the sense where it doesn't generate cash flow unless you build on it. And that's what strategy is doing. That's why I use the example. Bitcoin is like your raw land, and these preferred digital credit instruments are building materials being extracted from the raw land that developers like Westmain can assemble. And like STRC is like glass, STRD is like cement, STRF is like steel, and we can assemble those and erect our own, digital building that generates its own yield. And I think that's the kind of message here that we're trying to deliver over the past 27 weeks of the real estate standard. And if you believe it or not, Westmain has been stacking for 50 weeks now, coming up on the 1-year DCA anniversary on July 29th. And that's kind of like what you called the year zero for us, right? It was the year where we got off zero, and we're going to be able to kind of look back and run the numbers and compare 2024 versus 2025 versus 2026, the year after. And then going forward, we're going to have the data to back it up.
Wow, Westmain's birthday, Bitcoin birthday, is on the horizon, is what you're telling me. We're just shy of 3 weeks out. We're gonna throw a party.
Live stream party.
Yes, sir. Yeah, I mean, all good points. I don't disagree with them. Just kind of bringing it back here, we'll kind of put a bow on today's chat. But you think about, we were talking about it last week, right? Like the risk of tenants' credit, right? And how the credit of the tenants needs to be reevaluated. It needs to be re-rated. That's a big topic. It's an elephant in the room that nobody wants to touch with a 10-foot pole. I get it. It has dramatic implications across the industry, across every property type and every market, because spoiler alert, they're all inflated. They're all overvalued, which has impacts for the entire capital stack, all the way down. But I was just thinking of, you kind of think about some of these, I'm going to cherry pick this, but you think of some of these SaaS companies, right, that maybe occupied a significant percentage of a building, or the entirety of a building for that matter. That building traded as a leased investment on a 10, 15-year lease at a premium, right, in the capital markets. And now, that traded in, whatever, 2017, 2018, 2020. Now, fast forward, you have AI on the stage that has basically obsoleted more than one business model since it's been on the main stage here. And there will be more. We all know that. So I just think of some of those facilities that have, these SaaS companies, these incumbents that were valued at a premium because they were, large or publicly traded, what have you, and they were thought to be impenetrable or undisruptable, which is now could not be further from the truth in today's environment. So that aside, right, we're going back to this volatility topic. That tenant, that SaaS tenant, goes BK, they dissolve, whatever the situation is, and you're the owner of the building, you're left with a massive vacancy. Okay. Whatever that decline in value may be, 30, 40, 50, 70%, the difference between real estate volatility and Bitcoin volatility is, with Bitcoin, I can do nothing. Right? I can sit on my hands, I can be patient and wait for the market to recover at no additional cost. In real estate, not only have you lost significant value, but now you are required to put up significant capital to re-tenant that building, right? To get that income stream back to where it was, or better, or even close to it, right? I mean, I think that is that's a significant difference that can't be overlooked, right? I mean, if you, depending on your situation, originating a new lease, after you factor in all the costs, downtime, marketing, tenant improvements, commissions, concessions in the lease, what have you, you could be looking at a 20%, you could be looking at 20% of the total lease value just to get that deal done, right? So that's significant. And I think, bringing it back to Bitcoin, that is where these strategic reserves, that's where these other capital buckets come into play in a really meaningful way, because it helps you navigate those types of situations as a real estate operator.
Yeah, you're talking about like build to suit, or large leasehold improvements to attract more credit-worthy tenants. And there was some real estate guys in Rhode Island that would just buy raw land, put up the sign, and like that kind of model kind of works well with what you just described, right? Like, you buy the land, and then now you start putting your spare cash, assuming you have another revenue stream, towards Bitcoin, and you wait for someone to call the sign and say, hey, I want to do a car wash here, or like I want to do like some kind of building, and you can go build that actual property out. Like, you can put the drive-through tenant in, you can do whatever you want. Like, you have, if you've got the Bitcoin on the side, or the digital credit, or whatever you got stacked on the side, you now have a big reserve to build out for that tenant that comes along. I think that's just one example. I mean, it works for any property, but I'm also thinking of specifically build to suit tenants.
Yeah, absolutely. All right, now what else? Do we have anything else we need to cover? I think we ripped it pretty thoroughly today.
Yeah, I mean, we could always keep going. I think we can just keep going, but we got a busy schedule to get back to, so we'll save some time for next week to to chop it up again.
Kenny, are you saying this is
Alrighty.
not the Real Estate Standard digital conference?
Not yet. We're hopefully we'll have more speakers at that one.
Absolutely. No, that was awesome. Well, that's it for today's episode. If this conversation was useful and helpful, please share it with a partner, a client, somebody making decisions in this market. New episodes of the Real Estate Standard drop weekly. Until next time, stay disciplined, think long term, and stack sats. This is the Real Estate Standard. For Kenny Alves and Chris Drizga, I'm Tim Kotzman, and we will see you next week. If you enjoyed today's conversation and you own commercial real estate, we'd encourage you to think about how these broader shifts might impact your own property over the next decade. Many owners are starting to reconsider how they structure their balance sheets, manage capital, and position their assets for the future. If you'd like to explore how some of these ideas might apply to your own situation, you're welcome to reach out.